right, I am back with another edition of the Sunday Scary Stock Talk podcast. But before we get into it, I want to shout out our sponsor, Financial Stock Data at financialstockdata.com, at FSD_research on Twitter. Be sure to check them out. Use promo code GCI, as in Green Candle Investments, and you can get the first month free. You can go into financialstockdata.com and analyze any stock or ETF that you'd like. You get all the financial information, background, calculations of various metrics, and anything you really need to dive into the financials of stocks. So be sure to check them out and use promo code GCI. Now let's get into the episode where I'm joined by Nikki Dunn. I'm pulling her up right now. Nikki, how are you doing today?
Good. How are you?
I'm doing great. So we got connected through the stock market pitching game through Common Stock. I think we were kind of like on opposing sides of the bracket, but we both unfortunately didn't make it onto the next round. But I really did love your pitch there.
Thanks.
So why don't we get into, I guess back it up to the beginning. So tell me a little bit about yourself and your experience and how you got to where you are today.
Yeah. So I started as a day trader, day trading the E-mini futures, day trading stocks after that. And, over the years, the market was getting harder and harder. Stops were getting run, setups weren't working as well. The algorithms came in and, really to be a day trader, it can be quite difficult. I know some people are doing it successfully, but I just didn't have the patience anymore. And I wanted to not be latched to my computer. So I was fortunate to be introduced by a good friend of mine who ran a hedge fund. His name's Travis, and he taught me fundamental analysis. So basically diving into financial statements and learning how to value companies. And I was just a technical trader. I only focused on the charts. I didn't care about earnings. I didn't care about any of that stuff. And he kind of showed me this whole new world of fundamental investing. And so I said, okay, I really want to be more longer term, more swing trade style. So I started combining the technicals, which I felt like I got pretty good at. And I combined that with the fundamentals, and I was able to kind of construct a strategy that I'm much, much happier today doing. And also I invest for long term as well. Passive investing, active investing. And I am also a certified financial planner. So I've kind of got my hands in a little bit of everything. I'm a trader. I'm a financial planner. I specialize in investor psychology, and I help traders strengthen their mental game. I was able to develop my own mental strategy when I was learning how to day trade and mastering the emotions that come with day trading and with trading and investing in general, no matter what you're buying. So yeah, I've kind of got my hands in a bunch of different buckets. I consider myself, I guess, a jack of all trades.
Yeah, for sure. And that's really interesting. So I think, a lot of financial planners that I hear always kind of talk about, the basic fundamentals and invest for the long term. But you're kind of on the opposite side, or at least like your experience is on the opposite side where you started in day trading. Now, as a financial planner or, just if you're advising somebody, I come to you and I say, hey, I want to start day trading. What would kind of be your message to that right now? Because I feel like, you have a little bit more of a different background than, the average financial planner.
Yeah, that's a great question. And this is something that I have told people many times. My biggest mistake in my journey of the markets was I started as a day trader, and then I got into investing for the long run, because that's what everybody does. It's the natural progression. It's like, oh, I mean, think about WallStreetBets and, the Reddit forums and all of that. Everyone's like, I want to make quick bucks. How do I do that? Oh, I just trade some options, or I just, day trade the market, and I can make 10% a day and compound. It's like everybody wants that, and they chase that first, thinking that's how they're going to get super wealthy. But I think that that's a mistake. I think that the first thing somebody should do is actually master and get not even mastering, just literally get some money invested for the long run. That the money that's going to compound over decades for you, get that working first, and kind of learn how the market works. And then once you are maxing out certain types of accounts, or you're contributing enough to certain types of brokerage accounts for longer term goals, like retirement goals. I call it chill retirement. I don't like to call it retirement because that's not as exciting. So everyone wants to chill out, right? So your chill retirement goals, quote unquote. And then once you have the extra cash flow to dabble into the fun bucket of trading, whether it's options or day trading stocks or whatever it is, then you move towards that. So I did it the wrong way. And I tell people to not do it that way, do it the other way. Investing first, then the fun bucket, so to speak.
I gotcha. Well, I mean, even though you say now that you did it the wrong way, do you think that you kind of would have ended up where you're at today without kind of starting where you did?
I think that I would have probably compounded my money a little more efficiently, in the beginning, because I was so young. And when I started trading, if I was maybe a little bit more focused on that longer term goal, the earlier you start, you can compound so much. You put less capital in over time because you're literally compounding at such a young age. So I don't know. It's kind of hard to answer that for sure, but maybe my retirement goals would have been reached sooner, a little bit sooner. But I probably I am grateful for the fact that I was able to master the technicals when I did, and I was able to kind of dive into the charts and dive into how trading works when I did. But I do wish I was compounding a little sooner for the long run, if that makes sense.
Yeah, I got you. It definitely makes sense. So, I guess let's take it even like a step farther back. So, how did you even hear about investing or day trading or anything along those lines? Because I think in a lot of American households, and I'm not sure if you experience this where you're talking to clients, but money is kind of a hush hush topic, and maybe not on the forefront of a lot of people's minds. But I think as the millennial generation and as inflation is kind of, smacking everybody right now, everybody's kind of bringing that money conversation to the forefront and kind of figuring it out on the fly. So did you, have something where, maybe a parent or a teacher or something along those lines that kind of help you lead you to investing and kind of helping grow your money for the long term?
So I definitely did not have I grew up not I grew up actually poor. I didn't grow up with a lot. We had what we needed, but we didn't have, a lot. And my journey towards wanting to be interested in money actually started as a child. Unfortunately, I saw bankruptcy. I saw, just poor money decisions. And that actually is what drove me, I think. And then I was very fortunate when I was in high school. I met who is now my husband, who his name is Chris. And we run a podcast together, we run businesses together. And I was very fortunate to meet him at a young age. And I was already driven in that mindset of I want to be successful one day. I didn't know exactly what I was going to be doing, but I knew I wanted to be successful, and I was always, good in school, and I was on that path. And he as well was very much so strong-minded, entrepreneurial, and he wanted to be a business owner. And so the two of us met very early, and we actually kind of came up together in that world. He would take me to, conferences, and he was getting involved in different businesses, and I would help him in his businesses. And so it was like I was very fortunate for that. And he actually got into trading futures. And that's how I got kind of pulled into that whole world, because there aren't a lot of women in this world, right? In the world of trading and investing. And during that time, which was so long ago, I was like the only female in the whole entire room of traders at conferences and stuff. And so I was just one of those lucky women that had somebody that got me interested into this whole entire business. And I know a lot of women don't have that, and a lot of people in general don't have that, right? And so that's kind of been something that I've been very excited to get out there and inspire other women and inspire just other people that, hey, you can get involved in this too. Like, uh, just anybody can learn how to invest in the markets. It's actually not a big secret like the world makes it sound. It just takes a little bit of work.
Yeah, I agree with you there, and I also, I'm kind of surprised when I got into this realm too that I noticed it was mostly male dominated because from my upbringing, my dad's self employed and my mom kind of ran the books and helped her help my dad in the back end like that, and she was very much the money and the numbers person. And when I was, growing up, that's kind of how I got exposed to it. Was my mom was really pushing to me like, hey, when you start making money, you need to figure out what to do with it. Whether it's investing in stock market or real estate or something. And that kind of drove me and gave me that little push to figure it out for myself. So, how is your experience going? With being a woman in the industry, are you feeling like you can reach women a little easier because it's not necessarily maybe a man talking to them, or is it do you kind of have like a mixed client base? Like, how is the reaction to that, or do you even notice a difference?
Well, I started She Talks Finance for women specifically. And a lot of women, approached me and they were like, do you do investing conferences? Do you do this, that, and the other? I would love to learn from a woman. And that's how it all kind of started. But as things have progressed, my audience has definitely been very split between men and women. But even men enjoy learning from somebody who kind of tries to break it down a little bit, in bite-sized pieces that are maybe easier to understand. I think that a lot of teachers in this space, sometimes they can, like, spit out the information really quickly. And a lot of people, you don't realize how much people, like, you don't know what you don't know. And a lot of people, you we are in finance very used to jargon, right? It's very quick and easy to go straight to the jargon. And a lot of people really need things that you wouldn't think explained. And so I tried to do that. And I guess that's what's attracted people to me is the fact that I try to explain things, and somebody that doesn't know anything about it can come to me and literally learn from start to finish and start investing or learn how to research an ETF or know what the PE ratio is, something like that. So my audience has definitely become a bit more mixed between men and women, and I appreciate that. I want to be somebody that everybody can come to and learn something from, and no matter who it is, I'm here to help.
Yeah, exactly. Are you kind of noticing I guess, a difference in I guess the knowledge of the people that come in? Have you noticed maybe an uptick of people are kind of more aware as we're kind of running into more of like an inflationary times and things like Wall Street bets and other things like investing and maybe cryptocurrency and Bitcoin are kind of to the forefront of the news and news cycles, and we're seeing massive amounts of volatility. Are you seeing people kind of come now with at least somewhat of a knowledge of the stock market opposed to maybe, a few years ago where, or the pre-COVID days where, it wasn't exactly as big of a topic in the news?
Absolutely. I mean, it's been pretty amazing because I started She Talks Finance right before COVID hit, maybe like a year or so before COVID hit. And I knew that things were starting to kind of shift. Women specifically were becoming more invested in money and finance and talking about it with their friends more. But now it's like I'm amazed at the people that I talk to. As soon as they learn what I do, they have a question about a stock or they have a question about an investment. It's like, oh wow, like I love this. This is fantastic. And I've got my good friends. We've got a crypto group message right now because they're wanting to get some Bitcoin. They are seeing the sell-off as an opportunity to buy some Bitcoin, and they've been dabbling in that, and I'm like rooting them on, and I'm like, yes, like this is what it's all about. People, I'm preaching all the time, see sell-offs as opportunities. Don't be afraid of the panics. Bear markets are, times where we need to be in the trenches and doing the work. And it seems like the people that are close to me are actually listening, and they're, taking this as an opportunity. And they're coming to me and they're saying, hey, Nikki, should I, start doing this? Should I start doing that? And so that to me is very exciting, that people years ago would not even be thinking about these things, and now I'm getting flooded with people that want to start buying assets that normally wouldn't. And it's great.
Yeah, that is great. And you kind of mentioned it already, but Bitcoin and other cryptocurrencies. So as a financial planner, I told my parents have one, and I kind of brought it up when I first started buying Bitcoin a few years ago, and they were like, "Stay far, far away." So, what is your stance on it? And are you kind of seeing like maybe a shift in the financial planning industry where people are kind of becoming more open to it?
Yeah, I mean, advisors are definitely becoming more open to crypto. They're, starting to get more resources and more ways to custody the asset for their clients, and so that's good. That's coming online, but there's still a very large percentage of people in the financial industry that don't agree with putting any crypto in a portfolio. They are like, you're crazy. Absolutely not. If you're going to buy it, you need to buy it on your own account. I'm not touching that for you. I'm not advising you to do that. And they're covering their butts because, they have a fiduciary duty to do so. But I think, for my viewpoint, I think that if you stick with the quality coins that have proven themselves and been around for, I mean, I don't want to say a long time, because crypto's history is so short in the grand scheme of things, but Bitcoin and Ethereum, right? Like those are the two main coins that if you're going to invest, those are probably the two that you want to keep your allocation closest to. And so I think that what's key, I'm a mentor in a community, um and we have a lot of crypto individuals in there. And you learn that a lot of people have very high allocations to crypto, like scary high allocations. And that's not necessarily something that I support. I think that we should have diversified portfolios within reason. If you're 80% in crypto, you're gonna have a tough day during times like these. So I think that everything in moderation, utilize diversification, make sure you are aware of your position size of the crypto in relation to your net worth, and you'll be okay. But I'm definitely not against investing in crypto.
Yeah, that's interesting. And I guess along those lines, you've kind of talked about, diversification and allocation and, things like that. That kind of helps, stabilize your portfolio, so to speak. But have you seen, I guess, maybe some more openness or, a tendency to, when you're getting these investors who hear the Wall Street bets and all these other things where they're seeing them shoot up and down, are you seeing like a kind of a higher, I guess, a high, or better stomach to stomach a lot of these risks and ride the roller coaster up and down and up and down?
I think that crypto birthed some of the strongest stomachs of steel in terms of risk tolerance that I've ever seen. I mean, the drawdowns that they can handle and be totally okay with it and sit through it is is quite stunning. And I think that a lot of those people, their first investment was crypto, so that's just how they were trained. They were trained that an asset can sell off almost 100% and recover and go even higher. Like that's what Bitcoin specifically has done. It's had retracements that have been, almost all of the gains given back. It's wild. So yeah, I think people do have a little bit higher risk tolerance, especially those that were birthed investors that were birthed from crypto. Um and but I also think that that's kind of helping people learn that the ups and downs are more normal and that they're able to stomach them more. And now when those investors get involved in other assets, they're probably going to be better off. So it's definitely interesting to see the risk tolerance of some of these newer investors. Gen Z is going to have like the craziest risk tolerance. I don't know.
Oh yeah, for sure. I mean, and we've seen like, a few rug pulls and some other things that maybe people have been exposed to in the crypto realm and things like that, yeah, maybe they get a little skeptical or what. But you kind of we're all along the lines of volatility. And so I think, I haven't been investing for too long, but when I started investing, the narrative was just put it into an ETF, the S&P 500. You're going to get, your standard 11% on average return. And then, 2020 came along where they printed a bunch of money and the S&P returned about like 23%, I want to say, that year. So are you kind of noticing that investors are kind of not happy unless you're getting all these giant returns, even though, obviously there's a lot more volatility and a lot more swings in the stock market?
I think that in a lot of investors right now, especially, younger millennials and Gen Z, like the boomers know how it goes, right? The boomers have been in it, they know what's going on. Gen X, they same thing. They know what's going on too. Older millennials, we've been through the 2008 financial crisis. We've been through, now another, huge sell-off, the 2020 panic. A lot of investors have never been through like a real true grinding miserable bear market. And so I think that it's definitely going to be a wake up call for a lot of them, and they need to work on patience. They need to because everything has happened so fast. Like even in crypto, the gains have been fast, the sell-offs have been fast. The most recent bear market has been fast panic followed by a V bottom and then huge recovery quicker than you could blink, right? And I don't think that newer investors really know what really can go down. So I think that there will be some wake up calls if this market continues to kind of behave. It's actually behaving more like a normal market, to be honest. And I think patience is going to be super key.
Yeah, exactly. And I think, yeah, within the last couple of days, it's starting to almost like stabilize, it seems like. So, when you get people that come in and ask you questions more so on the macro environment, how do you, explain it now to, some, I guess, some clients that come in and, they hear the news headlines about inflation, high CPI prints, and maybe even dealing with a war in Russia and Ukraine. How are you kind of explaining how these scenarios and maybe the overall macro environment affects the underlying stock market?
Yeah, I mean, I've done a few videos about this on my YouTube channel, and the fact of the matter is we're dealing with high inflation, um, and the Fed is raising interest rates to try to battle that inflation. And just the nature of economics is when the Fed raises rates and the risk-free yield increases, and hopefully inflation. I don't know. We'll see what happens with inflation, but that's going to have people flee some safer assets. They're maybe going to move into more bonds. They're going to move out of equities, which are risk assets. They're going to move out of crypto, which is a risk asset. So the main takeaway right now is we know we know the Fed is going to continue to raise rates. We know that the market hates uncertainty. We know that we have tons of uncertainty right now. And we know that growth is starting to slow. Earnings growth. I'm talking about basically earnings growth. And we know that there are also some counter forces going on, right? We've got a consumer that is still spending technically a consumer that still has demand for services and travel after being in lockdown for years and not really being able to travel as freely, which could be a counterforce to the slowing growth. We've got unemployment rates at extreme lows. We've got job openings at highs, very, very tight labor market, which basically is counteracting the economy possibly going into a recession, right? If people have jobs, if people are, still continuing to have wages rise because of the tight labor market, maybe the recession doesn't fully happen as people are expecting. So the way I'm explaining it to everybody is we have these counter forces in our economy right now, and it's got to be one of the most difficult things right now to predict how the market is going to actually react to this. We know that the market has room to go lower. So I'm, trying to explain to people you have to prepare for that. If the Fed continues to raise rates, if growth comes in more, there's plenty of downside in the indices and the S&P or the NASDAQ, however you want to measure it. But at the same time, a lot of individual stocks have come in a lot. Valuations have come in a lot. And there's also this individual opportunity that's going on. So it's a very difficult environment to predict on the macro side. And then you throw the Ukraine war into that and supply chains and China shutting down. It's almost impossible. So I'm just trying to explain to people there are the counter forces. There's good, there's bad. And all we know is that rates are probably rising. There is some more possible downside in these markets, and to just kind of prepare for that.
Yeah, so to prepare for somewhat of some downswings, I guess too. So, I guess in an inflationary and maybe a down market or a bear market, what kind of things are you thinking that you're going to start looking into? As far as like companies go, when you're looking at financial statements, because I think from maybe a little bit after the recovery of 2008 until a couple years ago, even through the beginning part of 2020, a lot of these growth companies that didn't necessarily make money or anything like that had easy access to capital with low rates, and you kind of talked about the Fed raising rates already. And now they're having to increase wages across the board, and maybe some expenses are increasing. So that deficit that they're having of, spending and getting funding, but not necessarily making money is growing larger. Are you kind of worried about a lot of these, I guess, tech and growth stocks that have kind of boomed and taked off and benefited a lot from, necessarily like easy access to capital?
Yeah, and I think that what I'm doing is kind of allowing the market to do what it does and reprice. I think that we've seen a lot of things come in, like we've seen Zoom come in, we've seen even Shopify come in a ton, but like Shopify is still expensive to me, right? Like if I'm going to choose between Shopify and Square, I'm probably going Square. I feel like Square has more value. I know that was your pitch and I voted for you on in the stock pitching game. I actually am very long Square. It's my largest position in my active portfolio. So I do think that margin compression is absolutely a concern. Margins are still elevated from pre-pandemic levels, which is a good thing, but we're definitely starting to see margins come down. Walmart today was a fantastic example of a company that is growing revenues, but they're not as profitable. Profitability is being cut. They cut their guidance for the full year now, so they're not going to be as profitable as they expected, even though revenues are growing. But you got to think inflation, right? So revenues are going to look pretty good because things are so expensive. But Walmart, which is a heavy hitter. I own it myself. I've owned it for years now, and they're having issues. So a lot of companies, if they're not willing to raise prices on the consumer, they're going to start to have that problem. And some companies are doing well. I think the opposite of that today was Home Depot. Home Depot, I believe, beat across the board, and they, some companies are able to pass these costs through easier than others. I know that, like, do you know Corsair?
I
Um,
do not. So if you want
yeah,
to kind of explain a little bit of their background too before you get into it, that'd be great.
Yeah, so Corsair basically competes with Logitech. So gaming peripherals, keyboards, mouses, or mice, and other types of things that you can purchase, and different gear for doing streaming, live streaming, and stuff like that. So they compete with Logitech, and they literally said on a conference call, we cannot raise prices because we're trying to gain market share. And if we raise prices, we're going to lose our ability to gain market share. And that's their whole shtick right now is they're trying to gain market share against Logitech and, the other big heavy hitters in the industry. So, certain companies are going to be struggling more than others. And that I think is where the investor can pounce and kind of find out who has that pricing power. Marketplaces, they're probably going to do pretty well and have pricing power. And plus, as inflation rises, you're going to be taking a higher commission to as inflation rises and things get more expensive. So marketplaces are interesting. Think things like Etsy and eBay, and yeah, I guess those are probably the two main ones that I can think of off the top of my head. um but there are definitely going to be some individual opportunities. You just have to figure out who's going to be able to pass on the costs and continue to be profitable, who's not in super amounts of debt that can have free cash flow to sustain, continuing to go forward with their business and not have to run out of money. And those are really the two main things you want to, and they're growing revenues. And those are kind of the three main things that when I'm looking at a company, I'm looking at all three of those things to see, okay, is this going to make it, and am I comfortable with this investment?
Yeah, so you talked about, I guess, pricing power somewhat because you talked about, a little bit about, maybe a little guy kind of competing with the big players. Are you going to kind of see, or do you think that, in this ever changing environment, that we'll see maybe some smaller guys come in and be able to undercut the big guys, or do you see it kind of more so that the big players in a lot of these industries are going to have that pricing power and that brand name that is going to kind of benefit them, that maybe the consumer will spend a little bit more just for the quote unquote better product, even though they didn't give the other one quite the shot.
Well, I do think that consumers are going to start looking for cheaper products, so maybe they won't go with that brand name, whatever we want to think about, brand name headphones, or brand name. Maybe they'll go with a Android over an iPhone or something like that. I don't know. They'll start to shift their purchasing habits, and find things that are less expensive. But uh, if if the big guys can't do it, it's going to be hard for the little guys to do it, right? So I don't know. I guess that's to be determined, but I think that there are going to be consumers that start to shift behaviors into cheaper products.
Yeah, and I think a lot of things we're seeing, maybe even on like the restaurant level, for example. I don't know how it is where you're at, but I'm seeing a lot of these smaller local restaurants either having to raise prices or even close down, just because they don't have enough people coming in, or they're still kind of feeling the after effects from the COVID pandemic, and yeah, just they aren't being supported as much. And a lot of them are kind of struggling to get workers, and a long list of lines. But at the end of the day, they're not able to combat maybe these increased prices of meat per se, or something like that, because they're not purchasing quite in the bulk like a McDonald's is. And so I don't know. From my perspective, it kind of seems like a lot of these big guys are going to have that opportunity to kind of swallow up a lot of these little guys, at least in maybe some industries, maybe whether it's tech or restaurant business or something like that, strictly just because like the increased cost makes it difficult to start a small business and kind of start on that trajectory up to be able to compete with some of those big players. But one thing that I think is really interesting about what's kind of happened is that a lot of these or recently there's been a shift of people wanting to start small businesses. So as I guess a financial planner, when somebody wants to come to you and say like, hey, I want to start this business, especially during a time now, how are you kind of I guess advising them to go about and be prepared for that? Are you kind of telling them to have maybe a little bit bigger of a safety fund or something along those lines in order to kind of start along their entrepreneurial journey?
Yeah, I mean, it obviously depends on the type of business. Someone trying to open a restaurant right now, I'd probably be like, "Are you sure?" It better be, really good business plan and great food. That's a tough one. I mean, that's just a tough business to begin with in terms of, margins and how much work it is. But there are still, I think the entrepreneurial spirit is still alive and well, and I think it's very good to explore it. And I think there are ways that you can do it wisely and kind of bootstrap, prove a concept first before you go spending thousands of dollars on a beautiful website and all of this, software and etc. I think it's important first and foremost to prove the concept, and then once you do that, I just love the idea of bootstrapping a business if you can. Not everybody can do that depending on the business, but I love that. And I think that right now, you just have to be really mindful of your numbers. You have to really know your numbers, know what you can charge, know what your cost of goods is going to be. If you have, depending on the business, people that are doing creator type businesses and selling courses and things like that, that's going to be much more approachable than someone going into, like I said, the restaurant business or starting a brick and mortar store. But I think that know your numbers, understand that bootstrapping, if you can do it, is the way to go. Prove the concept, and then jump in with that expensive website or whatever it is that you're wanting to do, that expensive new machinery or product that you need to run your business better. Do that once you can prove that you can make sales.
Gotcha. And obviously you're an entrepreneur yourself, and it sounds like you and your husband had some businesses prior to as well. Does that experience do people kind of come to you because of your experience in that and your realm, or maybe they find you because of the content you put out? Is that kind of I guess helping you level with a lot of these new entrepreneurs or people trying to come in and become an entrepreneur?
Yeah, I get a mix of everything. I mean, the person that I can help the most, and I actually have a mentoring program that I designed to kind of help anybody that's either a freelancer or self-employed or a working professional go in and instead of, if you don't have access to spend thousands of dollars on a financial plan, you can basically learn everything that you need to know with my mentoring program. And that's kind of what I focus on mostly. And I attract a lot of entrepreneurs. Yes, I attract a lot of freelancers that mainly, and these are the people that I can help the most, is the freelancers and entrepreneurs that have absolutely no idea how their taxes work or how they should save for retirement if they aren't employed at a corporation, right? And a lot of people don't realize how they can have a retirement plan for themselves even if they are self-employed. They can still have a insurance. They can still live a normal life. I remember when I quit corporate America, it was very scary. It was very scary leaving my 401k, leaving my healthcare benefits, and a lot of people struggle with that. But you can design that for yourself, even if you are self-employed, and strategize on taxes even more. It's almost better. You can do so much more with tax strategy if you are a freelancer or self-employed. And so, or you run a business with employees, whatever the case may be for you. So I think that that is my experience more so in the markets is what seems to attract people to me. But what I try to tell them is making money is only half the battle. You have to plan the money too. You make it and then you plan it. And tax strategy, retirement strategies, investment strategies, it all goes hand in hand, and you can't really do one without the other. So I try to take that holistic approach, and I think that people that go through some of the things that I offer, they see that I put that together for them.
That's awesome. Awesome stuff. And so, earlier when, we decided that you were going to come on the show, we tweeted out, I think both of us did, and you got quite a few responses. And what you're talking about here with response or with retirement accounts, I think really ties into one of the questions. So you tweeted out, what are some stock and market related topics that some of your followers would like to discuss. And one of the first one was, how do you decide which stocks to put in a tax-free retirement account versus your cash accounts?
Yeah, that's a really good question. So I like to call it tax deferred, because it's technically tax deferred unless it's a Roth account. Then it's, you pull out the gains tax free. But a tax deferred account I love utilizing for trading, for like swing trading or shorter term trading. And the reason that I do that is because I don't want to deal with paying the taxes and filing the taxes on any gains that I may get from that short-term trading, because it's taxed, obviously, at short-term capital gains rates. So I actually focus on, and this is just kind of what I do as a trader. Someone that's an investor, it's going to be maybe a little bit of a different story. But as a trader, I utilize the tax deferred for trading to not have to deal so much with the taxes that comes with that. And then in a taxable account, I focus on long-term capital gains assets. So I want assets that are going to be compounding for many, many years, and they're earning dividends. And I'm going to later in life pull that out of a taxable account and take advantage of long-term capital gains rates, which, for anybody that doesn't know, long-term capital gains rates are more favorable and lower than short-term capital gains rates, which are what you're going to get whacked with if you hold something for under a year. So that's kind of how I do it. You have to think about tax location. It's not just tax strategy, but it's tax location is what assets do I put where. And so that's a very important question. That's a great question that everybody should be asking themselves. But if you're not trading and you're really just kind of investing for the long run either way, I think that maybe don't think about it too much. Don't get too obsessed with it. It's more so when you get into Roth versus traditional that it really starts to make a big difference into what assets you put into those types of accounts, if that makes sense. I don't know how deep you'd want to go into that. That's a rabbit hole.
Well, if you're willing to get down the rabbit hole, then let's do it. I guess let's get into the Roth versus traditional IRA kind of rabbit hole, because I think it's really interesting, one, and two, I'm kind of about to run into this scenario where it's I got a rental property, and I got other things now too, where I'm trying to find some ways to make diversified income, and I don't know if I'm going to be necessarily in like the Roth or that cutoff area. It gets kind of hairy, so I'm kind of worried on how to approach it myself.
Mhm.
So I'm sure that there's others out there like me. So if you want to get into the traditional and Roth, the differences and kind of how you look at those accounts as well, that'd be great.
Yeah, determining so a traditional IRA is where you get a tax deduction today and you pay tax later. And then a Roth IRA is where you do not get a tax deduction. You put in post-tax money and then it grows and you pull it out tax-free, the gains tax-free. So a lot of people are attracted to Roth. It's all over TikTok. It's all over all of these platforms. Everybody's like, do a Roth, 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 Roth. Roth is the way to go, Roth. But the fact of the matter is that's not always going to be the best choice for you. Like if you are in higher tax brackets, meaning if your income, your last dollar of income is falling into a lower or an a higher tax bracket, then Roth may not make much sense for you. And you may want to just get that tax deduction today and take advantage of that. So I think that you have to figure out where that last dollar of income is taxed. Figure that out. And, if it's in the higher, few brackets, that's where you might want to be thinking more traditional. If you are in the lower brackets, anywhere up to 22 to 24%, that's a pretty attractive tax rate to lock in today. So if you are able to contribute to a Roth, if your income allows, because if you make too much money, you can't contribute to a Roth anyway. So that's out the door. There's other strategies, but I won't go into those. Then yeah, if you're in the lower tax bracket, then you may want to lock in today's tax rate and just pay the tax, contribute to Roth, take advantage of that. But I just try to tell people that don't assume one is good over the other. Like, you've got to look at the full picture and figure out how important is a tax deduction for you. Because if you want a tax deduction, then you're going to be wanting to think more of the traditional route. And there are so many landmines with IRAs. It's so funny. People don't realize there are, with both traditional and Roth, there are these landmines you have to watch out for. Like, if you can't make too much money, or else you won't even be able to deduct your traditional IRA. So just some things to be aware of. It's not quite simple.
Yeah, that's what you're here for, right? To kind of help people navigate those waters in the traditional and then the Roth IRA. So, another tax question came in from Daniel, and he asked, "Can you discuss the differences of FIFO and the rest of the tax options there is?" And then the follow up is, "Which one is best if you're not going to withdraw money and just trade monthly?"
Well, just because you don't withdraw money doesn't mean you won't owe taxes on it. So, if you're in a taxable account, keep that in mind. And you only really care about different cost basis methods if you're in a taxable account. So if you're in that taxable account and you choose, so first in, first out, that's FIFO, first in, first out, last in, first out, LIFO. And then there's also, you can choose basically specific cost basis where you're kind of picking and choosing which shares you're selling if you can track it properly. And that is a much more complex process because you really have to be tracking it yourself. It's going to be tough for a brokerage to do that. Usually the brokerage is going to offer you, LIFO, FIFO, the standards. So last in, first out is basically like your last share that you sold is going to be the first one that gets sold. Or sorry, the last share that you bought is the first one that gets sold. And wait, did I say that right? I always get this confused. Last in, first out is the last share that you bought is the first one you sold. So LIFO is going to give you the lowest gain because it's taking the last share and it's selling it. Does that make sense? So
Yeah, that makes sense. Keep going.
okay. Yeah. So last in, first out is going to be what gives you the lowest gain. First in, first out is going to give you your higher gain. And that's where you're going to get into coins or shares that are probably going to be more in that long-term capital gains bracket. So that's the benefit of selling FIFO because it's, first in, first out, which is going to be longer time frame, and you're going to get the long-term cap gains most likely, not always, but so it depends what you're going for. If you're going for the lowest tax that you owe, then you may want to go with last in, first out, but that's probably going to be potentially shorter term cap gains. So you just kind of have to see where you're at. And usually there's tax software that I know with crypto specifically, there's tax software that'll show you, the differences between all of them. But with stocks, it's a little bit different because your broker is set to choose one or the other. And however you have it set in your brokerage account is that's it. Like, you can't change it. You can't just change it all. So you have to make sure that it's set the way you want it to before you make that transaction.
Gotcha. All right, so we got two more. One, they kind of preface it as a newbie question, but for everybody in the audience, there's no newbie questions. I think these all questions are good. If you've got it, I'm sure somebody else is thinking it. But they've always wondered about issuance slash supply. So who sets it? What's it based on? Can it change as a company grows? An example is like a stock split or something along those lines too.
So I'm assuming in this case they're talking about maybe supply of shares of a stock.
Yeah.
And
Yeah.
yes, companies can control, they can issue shares. They can raise money, raise cash by issuing more shares of their stock. What that's going to do is it's going to dilute investors because as more shares are issued, the shares that you own are going to become basically a smaller percentage of all of the shares that exist for that company, right? So that's called dilution if they keep just adding shares. Trying to think of a good example of Tesla issued shares. AMC is a good example. AMC issued during the pandemic like an insane amount of shares. I can't remember the exact amount, but the chart was like the share count was like this, and then boom. So AMC was a good example of that. And what that did was that diluted shareholders, which means that the earnings are spread across a lot more shares. And so AMC has not hit the moon yet. From last I looked, and a lot of that could have to do with the fact that there's so much so many shares of the company. But side point. So yeah, a company can issue shares and affect their share count or their supply.
Gotcha. All right. And then last question, it's more along the lines of macro. So there is stimulus being issued in China versus tightening in the West. So they want you to talk about, I guess, maybe the currency impacts of inflation versus demand destruction. So whether that's, I guess the battle between the currencies going on right now.
Well, yeah, I mean, China's in a very different spot. They are literally, yeah, that they. It's just kind of challenging to imagine that they're still locking down and still choking off their economy while we're all trying to get back to normal. But um, uh, inflation is obviously going to it's going to hurt people, and the dollar strengthening right now has a lot to do with the fact that we are raising rates. I mean, if you're going to invest right now, the US looks pretty darn good. And so that's strengthening the dollar, which in turn can hurt uh, emerging economies, right? So it's definitely a challenging environment, but inflation has got to get under control because it's really going to damage the consumer. And speaking about China, I don't, I'm not too plugged into exactly what's going on with that. And I don't follow the data as much as I do in the US. But China getting back online and China's economy getting back to normal is going to help a lot of US companies because a lot of US companies have China exposure. So we want to see China get back to a regular economy as soon as possible. And I think that that's going to help lift the global economy essentially as more countries come back online and allow their citizens to travel. And so we need to see more of that to get back to normal.
Yeah, I definitely think you're nailing it right on the head there. Is that we've kind of become almost like a global society where companies across the globe are connected in some way, shape, or form. Whether that's getting semiconductors from Taiwan or some other country like China, I know is a big exporter of them as well. And that affects businesses all across the United States. So yeah, I mean, I definitely think that you're nailing it on the head there. That more of these countries, if businesses start to open up and be successful, that is just going to benefit companies around the globe. Well, Nikki, thank you so much for your time today. I really appreciate you coming out and sharing your wealth of knowledge. why don't you tell everybody in the crowd, where they can find you and what else you got going on?
Yeah, so you can find me at She Talks Finance, basically across everything. YouTube, definitely subscribe to my YouTube channel. I put out a lot of market, macro content and just financial planning content for people. And Instagram, Twitter, all at She Talks Finance, and my website is shetalksfinance.com. And also for anybody that is interested in podcasts, I am a co-host of a podcast called We Talk Money. So just go to wetalkmoney.com and you can find the podcast there. And it's pretty good. It's a lot of kind of what we did here. So talking about the markets and getting into the news.
Yeah, awesome stuff. And if it's anything like this conversation, I'm sure you should share your knowledge on everything there too, and it's great. So everybody, go check out at She Talks Finance everywhere, and check out their podcast. I'm definitely gonna start tuning in, and I'm excited for it.
Yeah, appreciate it.
Yeah. So
Thanks, Brandon.
yeah, thank you so much, and have a great rest of your day.
You too.